Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Energy Fuels, a company that is rapidly becoming a cornerstone of the U.S. critical minerals supply chain.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. What we're seeing with Energy Fuels is a really fascinating transition. I mean, this isn't just a simple uranium play anymore.
Right. It's much more than that.
It's become this integrated story of uranium, yes, but also rare earths and, other critical minerals.
Okay, let's unpack this. The market seems to be betting on two major themes here. So, starting with the foundation, what does the latest data tell us about the uranium segment specifically?
What's really fascinating here is the margin setup. Uranium prices are structurally tight. Spot is around $82.50 per pound.
And the long-term price?
That's a little higher, near $86 per pound. But the real insight, the thing you have to focus on, is what management has said their inventory cost is.
Okay.
It's significantly lower. We're talking around $53 per pound.
Wow, that spread is huge.
It's a $30 plus expected cash margin. It sounds like they're just poised for a serious cash generation phase as they start selling into these prices.
So they're ramping up production then at some of their low-cost assets like Pinyon Plain and others.
Exactly. And that's the key. They are on track to exceed their 2025 production guidance.
That's a great sign.
It is. And they've explicitly guided for gross margins on uranium sales to actually increase through the end of 2026.
How's that?
Because those higher-priced long-term contracts are now starting to roll in and replace older, cheaper ones.
Okay, so here's where it gets really interesting for me. The rare earths, or RE piece, this seems to be where the company really differentiates itself.
It's absolutely the core of the strategic story.
So what makes their RE strategy so unique?
This raises that important question. Why is this company considered strategic? And the answer, really, is their main competitive advantage. The White Mesa Mill in Utah. The only one of its kind in the U.S., right? The only conventional uranium mill operating in the United States, yes. And they have successfully adapted it to process monazite sands.
Which is a key source for rare earths.
A key RE source. And doing this, it's a huge deal. It lets them bypass the single biggest barrier to entry, which is permitting and building a new processing plant. That could take a decade.
So they have the infrastructure, which is a massive barrier to entry, but are they actually producing anything yet?
They've hit a crucial milestone, successful pilot production of heavy rare earth oxides.
Okay.
They reported producing, I believe, 29 kilograms of high-purity dysprosium oxide through Q3 2025. Terbium oxide is expected to be next.
And that's a big deal because these are the higher value heavy REEs.
Exactly. Dysprosium or DTI and terbium TP, these are essential for high-performance magnets. Think defense, wind turbines, EV motors.
Right. And this all aligns perfectly with the policy tailwinds we're seeing. The U.S. government is clearly focused on achieving critical mineral independence.
It does. You look at the projections, it's something like a 9.4% compound annual growth rate for the U.S. rare earth market from 2024 to 2031.
So if we connect this to the bigger picture,
their positioning as a key domestic supplier, especially with growing concerns about Chinese export restrictions, just creates this huge long-term driver for potential government support.
You mean things like grants or maybe strategic offtake agreements?
All of the above. It makes them a strategic national asset. Now, let's quickly address their financial health, because this is what enables all that growth. Despite being in a massive growth phase, the balance sheet is, frankly, a pillar of the bull case. They are debt-light and liquidity-rich.
That's critical for a growth story that isn't yet profitable. What kind of liquidity are we actually talking about here?
Well, post-Q3 2025, they completed an offering of convertible senior notes. This move boosted their working capital to near $1 billion.
$1 billion. That's a lot of runway.
It is. And the terms were really favorable. The notes were issued at a very low rate, just 0.75%.
And the conversion price, that's always the catch with convertibles.
It's capped high, $30.70 per share. So it really minimizes any immediate dilution while giving them all that growth capital. It's a sign of a very confident management team.
It's clearly a team that is focused on reinvesting, not returning capital. But they are currently posting losses. So let's look at the bear case and the risks you should consider.
Right. And the biggest risks are timing, execution, and, of course, valuation. Street consensus expects negative earnings per share in both 2025 and 2026.
Which puts a lot of pressure on the stock.
It does, especially since it already trades at a very, very high price-to-sales multiple of roughly 46.7. That's much higher than industry peers.
We've also seen some noise about insider activity recently, right?
Yes. And that's a fair point to bring up.
Yeah.
News reports highlighted multiple insider sales in recent months, totaling millions of dollars.
And that can feed a bearish narrative.
It often does. But the bold counter-argument here is that these sales happened after the stock delivered a massive 147% return over 12 months.
So it could just be rational profit-taking.
It could be, not necessarily a crisis of confidence. And you have to remember that institutional ownership is substantial, around 48%, and it seems to be accumulating.
Okay, switching gears to the chart. What does the technical picture say about entry points right now? The stock has been pretty volatile.
Technical services classify the longer-term trend as bullish. There's no doubt about that. The price is sitting comfortably above its 200-day moving average.
So the main trend is up.
The main trend is up.
Right.
But the short-term moving averages are flashing neutral or even sell. This points to a corrective consolidation phase after that big run.
That consolidation, combined with the underlying volatility, suggests there might be some latent energy. Are there any immediate catalysts we should watch for?
Absolutely.
Yeah.
And with short interest so high, around 25%, any positive news could really fuel a move.
A potential short squeeze.
It's definitely a possibility. So the next major reporting cycle, Q4 2025 earnings, will be key for updated 2026 production guidance.
And beyond that.
Look for any announcements about offtake agreements for their rare earth products or further U.S. government policy support. Either of those would be huge.
So what does this all mean for you? This is clearly a high beta story. It's tied to execution risk, but it's also underpinned by these unique assets and really geopolitical necessity.
The investment thesis really suggests a 2 to 4 year multi-year hold. You need that time to realize the full value of the heavy RE ramp and the uranium contract harvest. The current consolidation might offer a potential entry point for those who are willing to underwrite that strategic value.
Here's a final thought for you to consider. Given the geopolitical push for self-sufficiency, how much of this company's valuation is driven by its future earnings potential, and how much is simply its irreplaceable status as a strategic national asset?
Something to mull over for sure.
Thank you for joining us for this analysis on energy fuels. Don't forget to subscribe and like so you never miss a future discussion.